Hello everyone, my name is Shiva Kittusamy and I am one of the instructors here at UNR Extension's Small Business Education Program. Today's class we are talking about understanding financial statements. We've got a lot of cool things that we're going to be talking about and ultimately how these things can be really impactful tools for your small business or startup. Before we get started, I'd like to give a little background on myself just to kind of let people know who I am. In case you're new to me as an instructor. So as you know, my name is Shiva Kittusamy. I actually just recently graduated from the University of Nevada, Reno with a major in finance with a minor in economics and entrepreneurship. I've had experience launching a startup, going to market, leading a team of 6, having to deal with financial projections, all this stuff. So taking what I learned in college and actually applying it to a real business. So a lot of the financial statements and some of the tools we're going to be talking about today, I've had actual practical experience with those items. So with that being said, I'd love to get started on this class. And throughout any of this video, if you have any questions or comments, just put that in the comments. All right, guys? So let's get started. So why do we need financials, or more importantly, financial statements? Well, there's 4 big line items that I like to highlight. First one is budgeting and forecasting. When you're a new business, you're going to want to forecast projections and all this stuff. So a lot of these statements can help with that. All right. Next is profitability analysis. If you're in business, you're looking to be in profit, not a loss. So these statements can help monitor your profitability. Next is attracting funding. This is personally my favorite out of these. As a business, especially as a startup, if you're trying to scale and grow, you're going to need funding of some kind. Even as a small business, if you're just starting out, you might not have enough capital to start. So attracting funding is going to be really, really important, and using some of these statements can help with that. And ultimately, strategic planning. So goal setting, milestone tracking, et cetera, et cetera. These can be related very, very highly to some of the financial statements we're going to be talking about today. So these are the 3 financial statements we're going to be going over. And these are basically the only 3 financial statements out there as far as US GAAP. All right. So first up is the income statement. So we got a couple different line items in the income statement. First one is revenue. This is essentially the total income generated from sales of goods or service. Very simple. Cost of goods sold is the direct cost attributable to the production of the goods sold by the company. So this includes the cost of the materials and labors directly used to create the good. Keynote, it excludes indirect expenses such as distribution costs and sales force costs. All right. Next line item is gross profit. This is the difference between revenue and cost of goods sold. So these 2 line items right here, it's just the difference between those 2. Okay. Next up is operating expenses. This is the cost required to literally just run the business. And these are not directly tied to production. And this is usually things like salaries, rent, and utilities. Next is operating income. This is the profit realized from regular business operations. And unlike gross profit, which only takes variable costs into consideration, operating profit or income also considers fixed costs, meaning that one of its main uses is to help management determine how well the organization absorbs its fixed costs, like the ones I mentioned, like rent, insurance, marketing, and other similar costs that are crucial to the sales process. Okay. So next up is other income and expenses. So this includes non-operating activities such as interest, taxes, gains, losses from investments. And finally, the last one, the The last line item is net income. This is the bottom line. This is calculated as total revenues minus total expenses. This indicates the overall profitability of the company. This is probably one of the most important ones if you are ultimately looking at what profitability your company has. And this could really be strategic in the planning stages of your company to really see ways to cut out specific expenses. And this really makes your business very agile, all right? But also, if you have a current business and you have these income statements and actual real numbers to play with, this can actually be really, really good to help tweak specific business practices. So, maybe with rent, seeing if you can get a discount by just paying it all front. That could be something that you could see change your profitability. All right. So next up is the balance sheet. The balance sheet is a basic snapshot of a company's financial position at a specific point in time, showing what the company owns, so its assets, what it owes, liabilities, and the value of shareholders' equity. Here's to the fundamental accounting equation. So guys, this is probably super famous in any basic accounting class. This is the accounting equation. All right, so assets equals liabilities plus shareholders' equity. I'm going to say it one more time. Assets equals liabilities plus shareholders' equity. All right, this is going to be super important in learning about the balance sheet and what it does. All right. And you might be asking, why is it called a balance sheet? Well, with the balance sheet, it has to always be in balance, hence this equation. So if your liabilities and equity are not equaling your assets, you're out of balance. It always has to equal each other. And you can manipulate this formula for different scenarios. But all in all, though, assets must equal liabilities plus equity. Okay? So going into assets more in depth. Assets are resources owned by the company that have economic value, which are categorized as current assets and non-current assets. Current assets are just cash and assets likely to be converted into cash within a year, and these can be things like inventory and accounts receivable. All right. Non-current assets are long-term investments. So think of property, plants, equipment, intangible assets like patents and trademarks. I always like to think current assets are a lot more liquid than non-current assets. All right, that's the best way I kind of distinguish them. So if you want to do a little exercise at home, maybe you can brainstorm what potential current assets you have and what non-current assets you have, or plan to have, I should say. Okay. Next is liabilities. These are obligations the company must pay to others, which are divided into current liabilities or non-current liabilities. Current liabilities are debts or obligations due within a year, such as accounts payable and short-term loans. All right. Non-current liabilities are long-term obligations, including bonds payable and long-term leases. All right. So if it's within a year, current liability. If it's not within a year, non-current liabilities. Cool. Next is shareholders' equity. This is the residual interest in the assets of the company after deducting liabilities, representing the ownership stake. It includes things like common stock or retained earnings. Common stock is essentially equity securities representing ownership. So, if you buy stock in a company right now, you're getting equity in that company, right? Retained earnings are just accumulated profits, not distributed as dividends, but reinvested into the business. There's also things like dividends, as just mentioned, that come from shareholders' equity as well, where if a company has extra money, they can just choose to give it out to investors as well. And that only applies to public companies, not private companies. Startups, small businesses, they could do something similar to their employees that have stocks or their investors. That's too far in the weeds. So, yeah, let's keep going. So, overall, the balance sheet provides a comprehensive view of a company's financial health and stability, indicating how well it manages its resources and obligations. It is essential for assessing the liquidity, solvency, and capital structure of a company, which will ultimately help investors and creditors understand the company's financial robustness. So this is kind of the meat and potatoes of your finances of your business. Okay. Next is the statement of cash flow. This is also referred to as the cash flow statement. This reports all the cash generated and spent during a specific period of time. So this can be a month, quarter, or year. The statement of cash flows acts as a bridge between the income statement and balance sheet. And this is really just showing how cash moves in and out of the business. I always like to tell people the biggest phrase is cash is king. This statement really just measures cash flow, as the other two statements don't really cover cash flow over a period. This statement also is usually given out to management, analysts, and investors for review. Another great use for the statement of cash flows is to compare cash flow to net income. This will essentially determine how well a company is running its operation, and also shows how much cash is on hand for a company in a specific time period and how much it actually receives from its operations. So, if there's too much cash going out, that's not good. You want cash coming in, all right? So there's really main three sections of cash flow. So operating activities, investing activities, and financing activities. Okay? These are going to be important. I would highly recommend taking a look at these three different sections of cash flow. Operating activities is very simple. It's basically all your operating activities. So, production, sales, etc. Investing activities is investing into plants, equipment. You get it. And financing activities is, paying accounts receivable, things like that. I would highly recommend going more in depth into what these three different items are, as there are a lot more details on these three items. Okay? And that's it. These are the three main financial statements you have to worry about with your business. It's a very short class, but these tools, if you will, are going to be very instrumental in having a competitive advantage over your competitors. All right? So if you can master these three statements and know what's going on, you're going to kill it. And you're really going to make sure that you keep growing and keep creating goals, because I think as a business, in order to grow, you need to have goals set. And with business, your goals are very tied to your finances. So using some of these statements can really help make sure those goals not only are achieved, but are also realized. So that being said, thank you so much for coming, or not coming, but watching this video. I know it went kind of fast, but feel free to go back. That's the beauty of these recordings, and really just take a look at some of the slides. If you have any questions, feel free to comment that down below. I'll try to get back to you. Other than that, if you do live in Vegas, we do have these classes also in person, and I would highly recommend attending these classes as we go more in depth and people ask questions. It can really help you see a different light for the topic that's being taught. So again, these videos are great for anyone to learn absolutely for free. So with that being said, thank you so much for watching my class. Highly recommend you watching some of our other videos. But until then, I'll see you guys in the next video. Peace.